Hello and welcome to the first Economics A-Level podcast for the pig at school. I wanted to try recording some things. First one's going to be on the state of the UK economy that will hopefully help you in your A-Level studies. One of the most important things you're going to have to learn to do, or if you're halfway through, hopefully already have some grasp of, is that everything you do, especially in macroeconomics, is going to have to be related to the current state of the UK economy. So that generally means the four main macro objectives: high economic growth, low unemployment, low and stable inflation, and a trade balance, so your balance of payments equaling. There are three others that governments tend to look at: keeping inequality relatively low, keeping environmental impacts down, so your negative externalities, and recently you would have heard in the news all your austerity arguments, keeping a balanced budget, so having a budget deficit for the government, minimum or balanced. So we're going to go through these one by one. So the first one we're going to look at, the one that's measured most, you'll see it in the news, is economic growth. So this is an increase in productive capacity or productive potential of your economy. It's measured via GDP, gross domestic product. Currently in the UK, our economic growth is 0.3% in the last quarter. So that's the last 3 months we've grown by 0.3%. But over the last year, we've grown by 1.7%. This is below the EU average. So despite the fact it's positive, it's growing, it's quite flat. Questions you'd want to ask if you're evaluating it are: which sectors are doing well? Is it service? Is it manufacturing? And is there an output gap? So are we growing at our trend rate of growth or below? And at the moment, we're actually growing below. Then we've got unemployment. At the moment, we've got unemployment that is at a record low of 4.5% and is falling. But again, if we're looking at how to evaluate it, we want many questions to be answered. So many of these jobs recently created are in 0-hour employments, or the so-called gig economy: your Deliveroo drivers, your lorry drivers, your Uber taxi drivers that have very unstable jobs, no holiday pay. We'd also want to look at the level of pay. There was another report out this morning saying that weak wage growth is set to continue in the United Kingdom. So we want to know what the real wages are. So are our wages going up, but inflation, prices going up by more? We'd also want to know about these jobs. Are they part-time? Youth unemployment is still relatively high in the UK. And we've also got underemployment. So people that might be only working 10 hours a week want to work 20, or work 20, want to work 30. So always question what these figures actually show. We've then got inflation. So post the Brexit vote, nearly 2 years ago now, was it 2 years ago? No, year ago. There's been a sharp increase in inflation. The Bank of England's target is to get inflation at 2%, because you want some inflation. You don't want to go into the danger of deflation, of prices falling, people delaying purchases. So prices have gone up round to about the 2% mark, 2.6% currently, but it has drifted nearly as high as 3%. With inflation, you're going to want to know whether it's cost push or demand pull. Is it your aggregate demand going right, people spending money, or is it your aggregate supply going right? Is it your costs going up? Now, at the moment, this is most definitely inflation of the cost push variety. Just mentioned a minute ago that real wages are low, so consumption is relatively flat. Businesses aren't hugely investing, so AD isn't exactly soaring to the right, but input costs are. So because of the fall in the exchange rate since the Brexit vote, the cost of raw materials, oil being the main one, but many other raw materials, especially for manufacturers, has gone up. So they've put those price increases onto consumers, or some of them. We've then got trade, or balance of payments. This is our total value of imports minus the total value of exports. We've got the current account, which is trade in goods, trade in services, income flows, which is businesses' profits going to and from the UK, and transfers, so money going one country to another without a good or service coming across. There's also the capital account, which is financial assets and selling of properties and things, but we don't need to know too much about that at the A-level level of it. So the UK has had a persistent trade deficit for 30, 40 years. There's only been about 2 years in that huge period of time where the UK has not been importing more than we're exporting. We've got a very high marginal propensity to import. So that means if people in the UK get higher wages, get more money, a lot of that, because we buy many of our goods from abroad, are brought from abroad, so therefore our deficit worsens. The exchange rate falling recently should or will make the United Kingdom's exports cheaper, but it takes generally a while for that to adjust. So at the moment we're still importing probably the same level in terms of quantity of goods from abroad, but it's just costing us more because of the exchange rate. It's 3.1 billion a month pounds in deficit at the moment. A couple of other ones, they're the big four, they're the four main macro objectives you'd look at in your essays, but you'd also want to look at things like productivity. So your productivity is output per worker hour. So it's how much each worker produces, basically. So if you think of it on a classroom level, it's how much you produce in an hour sat in the classroom. So it's how much each worker produced. It's not great for the UK in this. They've got the lowest level in the EU, and they're below the pre-2008 financial crash levels. So British workers aren't particularly productive. There are many arguments or reasons for this. It could be that there's lack of investment in training, so people don't know how to do their job. We might have too many workers doing jobs, so you're sort of taking work off other people. People might be matched poorly to their job, so they might be in the wrong job when they've got a wrong skill set. So that comes into leaving university and school as well, and the right advice being available. Then we're on to inequality. Inequality is measured by something called the Gini coefficient. The Gini coefficient is between 0 and 1. If it's 1, it means one person has all of the income or wealth in the country. If it's 0, it means you've got complete sort of communism, that everyone is getting the same. In the UK, inequality is pretty wide. It has fallen slightly in recent years, but that's more to do with some very rich people at the top losing money or earning less compared to those at the bottom actually gaining more. So the UK's inequality is still pretty wide, close to the US levels, which is some of the worst in the developed world. For countries that have got a Gini coefficient that's nearer to 0, you're looking at the Scandinavian countries generally, Norway, Sweden, Denmark. They're the ones that are generally, through more progressive taxation and generous welfare systems, have a lesser degree of inequality. And the last one that I mentioned that wasn't environmental, which is very difficult to measure, is the national debt or budget deficit. Want to get those two correct when you're defining them. Politicians quite often on purpose get those mixed up. The budget deficit is how much the government is borrowing per year, so it's their tax revenue, their tax take in 1 year minus what they're spending, but that's only in 1 year. The national debt is all of that added up, so it's all your previous deficits added up. Generally this debt, people say, who do we owe this debt to? The majority of it is not owned abroad. It's owned mainly to its own people. So government bonds are government debt sold to financial institutions. My pension will have some government bonds in it, and these will be paid back. It's essentially an IOU at a future date. The budget deficit in the UK is 89% of gross domestic product, which sounds a very scary number, but if you compare it to other countries, other developed countries, Germany, France, it's quite similar. As expected, if you've seen any of the news in the last few years, Greece is incredibly high. It's something about 220. No, it's not for the deficit. That's the debt. Greece is about 130%. Our deficit is falling. Our deficit is 3% of GDP. It was a lot higher. It was about 10% in 2010, just over. So the deficit is falling, but the national debt is increasing. So the amount the government is borrowing each year is going down, but it's still debt. It's still adding to that overall figure. So this is why you would have heard of austerity, which is the government taxing more, spending less to try and get that spending under control. And the main reason government wants to get that spending under control is, like, if you borrow money from a bank, you'll have to pay interest on it, and that interest is obviously eating out of your day-to-day spending. Okay, so that's your whiz through the current state of the UK economy in your four to seven macroeconomic objectives. So just remember, in your essays, you need as many real-world examples as possible. You need as many current policies as possible, and you need to quote those current figures, or more importantly, what is happening in terms of the trend of those. Thank you.